Good afternoon, Eric Mashinsky with the Gold Investment Letter. Today is October 6th. I'm extremely pleased to have Michael Pento on the webinar today. I wanted to bring Mike in and bring him back. We had the privilege of listening to him speak at our Phenom conference back in March. It was very well received in terms of a higher viewpoint, macroeconomic viewpoint of the state of the world and the bond market and gold and stocks and various metrics that will help us get a little bit of a bird's eye view of what's going on in the world. Michael's been on all different types of news channels and quoted in major publications, and most of you would recognize his face. But we're just going to keep it focused on the PowerPoint so you guys can see the data. Michael, how you doing today?
I'm doing fine, Eric. Thanks for having me back on.
Beautiful. So basically, what I'd love for you to do for my subscribers is, I know you have a PowerPoint, it's up. Tell us what's going on out there.
Okay, so basically, the global elites have solved absolutely nothing when it comes to the world's problems that were extant prior to the Great Recession. And I created a portfolio called the Inflation Deflation Dynamic Portfolio, which intends to capitalize on this chaos that's here now and will be more evident in the future. And what it does is it seeks to identify the cyclical periods of deflation and inflation, and then invest on that spectrum accordingly. And you have to ask yourself this question: why do investors need to hedge against both inflation and deflation conditions? And the reason is this: because the level of global debt has become so untenable that debt must be defaulted upon either through inflation or deflation. In other words, what I'm saying is central banks must either continuously monetize debt, print money, take interest rates very, very low, almost to zero and negative in some cases, or allow the gravitational forces of deflation to take hold. And if you can identify where we are in that spectrum and invest in accordingly, I believe you'll far outpace the returns on the S&P 500, and most importantly, will be able to protect and profit from the third 50% correction in equities since the year 2000. So let's go through some of the dynamics here that we actually are facing, and so I'll give you some data points. I'll try to quickly go through these, but the PowerPoint's available for your audience to peruse on their own time. So governments and central banks, as I said, have fixed nothing. The unwinding of the biggest bubble in history is still ahead of us. Just to give you some data points, a 10-year government bond in the US yields 2.4%. The average is over 7%, according to Bloomberg. Of course, Japanese 10-year yields nearly 0%, and the German 10-year Bund, 0.4%. So these yields are evident of a massive bubble in treasuries. And if you look at the bubble in treasuries, every other price in the world is geared off of that indicator, that free market, supposedly free market indicator of interest rates. Now, record low yields that have been in place for years, and even though that's the case, US GDP has been stuck around 2% since the end of the Great Recession. And meanwhile, global debt, as I said, has soared to an all-time record high. And that led to persistent and anemic global growth, soaring debt, 0% interest rates, negative interest rates. In fact, a quarter of the world's developed sovereign debt has a negative yield. And of course, we have inflation targeting, and that is a pernicious combination, very pernicious combination. Here's a chart I'll run through real quickly. 10-year bond yields from the United States, going back just over the last 10 years. If you open up that chart, you'll see that they peaked around 20% in the early 80s, and now we're down to the very low 2s. And here's a chart of the German Bund, 10-year Bund, down, 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 and that is only because of one reason. It's not because of very solvent fiscal conditions. It's not even because we have no inflation. It is because central banks have usurped the free market and interest rates. And quickly, this is the biggest example of all: the Japanese 10-year government bond yielding 0%. The nation has a 250% debt to GDP ratio, an inflation target of 2%, yet somehow somebody is buying these bonds, and that somebody is solely the Bank of Japan. Without the Bank of Japan, the Japanese 10-year bond would be well north of 4%.
So, Michael, on that
Sure.
note, with Japan, I mean, Japan
Sure.
they're the furthest along in this mess, by a decade or so, 250% of GDP. This is crazy. How are they going to get out of it?
They can't. They
I know
cannot
they
get
can't.
out.
So how do you see it end up?
Well, here's the problem. Here's the problem, Eric. The reason why the Japanese yen is only down some 26% over the past year, and hasn't collapsed like Weimar Republic, the German Reichsmark, or the Hungarian Pengo. The reason why it hasn't done so is because the ECB has been printing, or still printing, 60 billion euros a month. The Fed ended QE in 2014 and has just started quantitative tightening in October this month. They'll start to unwind their balance sheet. But there hasn't been a real trenchant difference between the money printing of the Bank of Japan and the ECB and the Fed. That's all going to change in 2018. In 2018, the ECB will be, supposedly, if they follow along to their projected path, they will be out of the QE business. They will be printing 0 euros per month, and the Fed will be selling $60 billion worth of bonds per month come October of 2018. And that means that the Japanese yen will be on a very oiled down toboggan ride slide down towards well north of 100 to the dollar, maybe even closer to 200 on the dollar. So there is no hope for the Japanese yen. There is no hope for the Japanese people. Their ridiculous situation is going to be revealed in 2018. Don't forget, I'd like to remind you and your audience that the BOJ is also owners of over 50% of the ETF market. Now, how can Shinzo Abe, the head of the Premier Abe, or the head of the ECB, Mr. Kuroda, how can these leaders ever announce that they are going to remove their bid from bonds and in equities? Because if they did, equities would immediately collapse and bond prices would collapse, yields would soar. And when you have a quadrillion yen in debt, that means it's the end of your society as a whole. As it is, Japanese is an island nation with no resources, a very aged demographic spectrum, no immigration. So they're in a lot of problems. That's the, like you said very accurately, they are the nucleus. They're ground zero of this unsustainable situation. And I would expect that to be one of the first areas where you see the chaos to break out. But quickly, turning to the Greek 2-year government bond, this is what happens when central banks don't promise to buy everything that's not nailed down. You look at this yield went to 350% in the summer of 2012. That's the Greek 2-year note. So Mario Draghi came out in the summer of 2012 and said he will do whatever it takes to keep bond yields low. Well, he's not going to do that in 2018. And this is where they are headed without continuous and perpetual printing from central banks. CPI in the United States, Eurozone, and Japan are rising due to increase in central banks' balance sheets. Here's a picture of the U.S. central bank balance sheet. Went from around 700 billion pre-crisis 2008 to 4.5 trillion. We have the Japanese central bank's balance sheet, which is up and away. That's never going to stop rising because the free market can never be allowed to come to the fore in Japan without a complete breakup of the entire economy. European central bank balance sheet, it's much the same picture, lower left to upper right. And Eurozone inflation is up 2% year over year. German inflation 2.2%, highest in 4.5 years. So you have to ask yourself, if I have inflation here in the United States and in Europe approaching 2% or around 2%, I think today was the non-farm payroll report that showed wages were up 2.9% year over year, and I have 20+ trillion in debt. My deficits are approaching 5% of GDP. You have to ask yourself, what in the world is the 10-year doing anywhere near 2%? So that's the effect of central banks, and we are being told that's going to end, and it's going to end badly, and you better have an investment strategy that can capitalize on that. Switching here, inflation is not extinct. If you look at the components of CPI since 2000, you can look for yourself. I'll quickly go through it, but look at medical care through the roof. Look at college tuition through the roof. So we haven't abrogated inflation by any means. In fact, inflation could get, after this next depression, a lot worse when central banks resort to helicopter money and artificial negative interest rates, negative nominal rates.
Michael, one thing too, I think everybody's curious about this. Back in the day, after the Fed started flooding the system after the crisis, with the amount of money that they've put in terms of liquidity and just flooding the system, people talked a lot about the reason we weren't seeing inflation out there was due to the velocity of money. How do you interpret that that take, number one? Number two, where does that stand today?
Okay, so the velocity money is still very low, but if you, first of all, that's a great question. Let me answer that as succinctly as I possibly can. So inflation is not a function of the Phillips curve, and it isn't even a function of the size of the monetary base, the base money that central banks create. Inflation comes from when the market believes that the purchasing power of a currency will become depreciated. That is the definition of inflation. Now, why does that most often occur? It occurs because of a massive increase in the money supply. And we talk about money supply, you have to think of the way Austrians, I mean, it's hard on this webinar to give you the true money supply definition and the base money supply definition, but think about it this way. The Fed creates, and central banks create one thing, that's base money, it's credit. If the credit is not expanded out, in other words, if the credit is not loaned out to the broader aggregates, if you don't go to the bank and say, I want to take a loan, the banks have the credit, they have those reserves, but those reserves are lying fallow because people are debt disabled. We live in a debt disabled world. And coming at it, and I'm going to, the next slide will prove this, if you're debt disabled, you can't afford to take out new loans, even if the money that they're lending you is at an all-time record low interest rate. And without that new money supply being loaned out to the public, the money supply growth rate in the broader aggregates remains very, very low. And that also means that the velocity of that money will remain low. So how does the money supply grow very quickly? What's going to happen, as I alluded to in the last slide, if central banks do an end run around primary dealers, private banks, and send money directly to the government and to people, then the money doesn't have to be borrowed, it's just given, and the money supply grows. So that's why we didn't see this huge breakout of inflation. Do we have inflation? Yes. Is it unsustainable? Is it untenable? No. And that is because of the debt-saturated condition of the global consumer.
So two things come to mind with that. Number one is what you're saying is velocity isn't necessary for an inflationary environment, because what you're saying is that if the dollar is going to depreciate, that's the main cause. And we're already seeing that now. I mean, we had a very strong dollar for years, which I think was sort of the best, worst house on the block run for liquidity after the crisis. But now we're seeing the dollar get hit a bit. So velocity in and of itself is not what's needed. I mean, we know that inflation is always and everywhere a monetary phenomenon, but when you're talking about it kicking into gear, velocity is, and really what you're also saying with the getting the banks out of the way and giving the money directly to the people, that's kind of what the Fed has done with the stock market and the real estate market, hasn't it?
Well, they still use the banks as a conduit, but what you said is very true. So you think a thought experiment, what could happen with inflation? Suppose China starts trading oil in a yuan-backed gold, a yuan that's backed by gold, excuse me, a yuan that's backed by gold. Well, if our foreign creditors no longer need to hold massive dollar currency reserves to trade commodities, then you'd see the dollar depreciate rapidly on the international currency exchanges, and that could lead to a lack of faith in the dollar's purchasing power domestically, and that could lead to a breakout of severe inflation. Think about another thought experiment. Suppose the United States military was obliterated overnight, and we didn't have the backing of the greatest military on the planet any longer. That could cause a lack of faith in the currency. But what most often causes a lack of faith in the currency is exactly what you said, a monetary phenomenon. a broad and systemic increase in the growth rate of the money supply, not the base money supply, but the broader aggregates. And that could happen and will happen in the case of helicopter money or negative nominal rates. And that's where I think we're headed after the next recession.
Well, good points. And I think, when we look at a basic way for people to understand this with the value of the dollar, it's just dilution. I mean, when they keep printing, it's like if you own a stock and company keeps raising money, except in this case, they're just printing it. They're increasing liquidity. But obviously, if you went from 1 banana to 100 bananas available for sale, the first banana is not as valuable anymore. So in any event, I know we've got some slides to run through, but I want to circle back to the Won-backed gold and the gold situation then as we finish up.
Well, before I leave this one, your banana analogy, you need to have more bananas, not just the credit to buy bananas, but you actually have to have more bananas. So it's the money supply as defined as M3, not as the monetary base, or MB. So monetary base doesn't necessarily lead to inflation. We went from 700 billion to 4.5 trillion in Fed credit, in the size of the Fed's balance sheet, and in excess reserves in the banking system skyrocketed. But it has to lead to lending. So you have to think of that. That is going to be the cornerstone of the next inflation crisis. Will be a depreciation in the market's perception of the purchase power of the dollar due to helicopter money and negative nominal rates. So artificial record low interest rates produce a massive increase in debt. This is how I know the problem hasn't been solved. According to the Institute of International Finance, global debt increased to 217 trillion in the first quarter of 2017. That's 327% of GDP, an increase of over $60 trillion since the Great Recession. Now, China's debt increase accounted for 1/3 of global borrowing since 2007, and they're at 300% of GDP. We here in the United States are some 350% of GDP. China's debt more than quadrupled to nearly 30 trillion from 7 trillion in 2007. Total non-financial debt in the U.S., this is non-financial debt, in 2007 was 33.2, now it's 47.9. Household debt is at an all-time record high, from 14.1 trillion to 14.9 trillion. That's just household debt. So this is crucial. We have not deleveraged one penny, not even on the household side of the ledger, since 2007. Maybe in terms of GDP, in terms of income on the margin, but nominal debt is at an all-time record high. And 2016, the fastest rise in household debt was the past 10 years in 2016. Here's total outstanding debt by country. You can go through this on your own time. Just look at that total debt as a percentage of GDP. Untenable and unsustainable. Again, no deleveraging whatsoever. Now, debt bubbles abound everywhere, thanks to the Federal Reserve and the ECB, the Bank of Japan, the Bank of England, taking interest rates to 0 and below and leaving them there for 8 years. Like I said, the cornerstone of an economy is the interest rate. And if the interest rate is morphed and deformed down to 0 and below, then everything is going to be deformed. So real estate prices are above the record high hit in 2006. According to Experian, there's $1.4 trillion in student loan debt, average balance 30,000. Business debt has increased over 30%, $1 billion in auto loans, 20% of which are subprime. The equity bubble is off the charts. The median price to revenue ratio of the individual S&P 500 component stocks now stands just over 2.45, which is the highest in history. The long time average for that metric is less than 1. And you have, of course, Robert Shiller from Yale. S&P 500 now trades at 31 times the trailing 10-year average earnings. That's higher than 1929. I remind you what happened in 1929. The average PE, they call that the cyclical PE, is 16.7. We're at 31. I think we're a little bit overvalued, don't you say? Wouldn't you say, Eric? Here's one of my favorites. I actually put a separate slide for. This is the Wilshire 5000 total market cap to GDP. So it's the market cap of equities represented by the denominator of the economy. And look how far we are. We have never been this high, anywhere close, really, outside of the year 2000, we know what happened in the year 2000 when the NASDAQ lost 85% of its value. We're even higher than that. So you want to have an advisor that can identify when this situation is going to change, protect and profit from the next collapse, which is coming soon, I think in 2018. Here's a quick graph that shows that when interest rates rise, bonds lose value. It's not, not a unique theory on my part. It's a mathematical fact. But to look at how much you'll lose in bonds is actually absolutely startling. And that's going to happen, I believe, as central banks remove their thumb from the scale. When the sovereign bond bubble breaks, it will take all other fixed income investments with it, along with equity prices and real estate values. This is mostly a repeat of previous slides. The bursting of the bond bubble could cause equities to lose at least half of their value. And that would be the third time that has happened since the year 2000. And also home values could fall between 26 and 30% once again. The real estate bubble circa 2006 is dwarfed by the bubbles today. So the bubbles today are much bigger. The size of the global bond market is $100 trillion, $10 trillion of which has a negative yield. Governments are borrowing and getting paid to borrow. You're giving money to the government and guaranteed to lose money in nominal terms, and even more so in real terms. So this is a very, very unusual period of history in never before, unprecedented conditions that are extant. In comparison, the total U.S. mortgage market was $14.6 trillion, and the subprime was only $1.3 trillion back in 2007. Real estate bubble is a U.S. phenomenon primarily. The bond bubble is global in nature, and as we said and identified, its nucleus is in Japan. So here's the danger of what most people will say, well, what do I need you for, Pento? I could just buy 50% stocks, 50% bonds. And when bonds collapse, when equities collapse, won't my bonds go up in value? Well, the crash in bond prices is not going to lead investors into stocks, and vice versa is also the truth. The market could look a lot like it did throughout the 1970s when bond prices plummeted and yields soared as the stock market just stagnated. Here's an example. In March of 1971, the S&P 500 was trading at 100 par, and the 10-year yield was 5.53%. By the end of the decade, the benchmark yield soared to 12.6%, so you got crushed if you owned bonds, but the S&P 500 was still trading at par. So after losing 40% of its value by 74, the market managed to climb back to 100 in March of 1980. So you found no offsetting protection. In other words, what I'm saying, when bonds and stocks are both in a bubble concurrently, you cannot hedge yourself by owning half of each. It's not going to help you. The era of the 70s, marked by high inflation and low growth, proved the great rotation theory doesn't work during times of stagnation and stagflation. Beware of central bank successes. I believe that eventually, I'll just quickly go through this slide. Eventually, central banks are going to be successful. So on the other end of this iteration of deflation and inflation cycles, I think the central banks are going to cause a breakout of deflation, which is going to cause a recession/depression to break out globally. And on the other side of that, you will see helicopter money and negative nominal rates deployed. And that also necessitates them to remove cash from the society. If you can take money out of a bank, the negative interest rates don't work. So look for a cashless society, one with negative nominal rates and one with helicopter money. And that means they're going to be very successful in creating inflation. So that dynamic pendulum will swing very wildly and exacerbate the moves greatly going forward between inflation and deflation. So if inflation doesn't break the bond bubble, soaring debt ratios will. And this is what you're saying. If central banks can't create sustainable inflation and growth, then debt to GDP ratios will continue to soar towards that of Greece circa 2012. Next slide. How to protect your wealth. Look at the inflation-deflation pendulum that I created. So central banks will, at different times, invert the yield curve and cause long-term bond yields to soar. Will be vacillating between those two conditions, and you better know how to invest your money during those conditions. So massive money printing, manipulation of interest rates and asset values, and record debt accumulation have engendered conditions much worse than the Great Recession 2007, 2009. And it's mandatory to have a portfolio protection that hedges against both inflation and deflation. Unprecedented manifestations of both inflation and deflation conditions is going to come to the fore. Passive investing currently is massively in vogue, and it's mostly in ETF. So a passive ETF strategy dominates Wall Street, and why not? You could just throw your money at an SPY ETF and you're fine so far this year. But active investing will make a comeback, and alternative strategies, including precious metals and short market investments, will become mandatory. However, if you agree with anything I've said here, and you said, you know what, I'm just going to buy a portfolio that's 50% gold mining shares and 50% short stocks, then you're in trouble. Because you did that in the last few years, you've lost a hell of a lot of money. You have to know when to overweight gold and when to short stocks. That's what my model does, and that's what I believe I'm very good at doing. Here's my model components. I look at household and public sector debt levels, treasury break-even spreads, the private balance sheet's condition, private banks' balance sheet conditions, global, of course, global central bank monetary policies, the interest expense and sovereign debt, trade and current account deficits, commercial industrial loan growth, monetary aggregate growth rates, commodity and equity prices, the direction of real interest rates, and the trend of strength or weakness in the U.S. dollar. And here's just a sample.
Michael, before we get into the some examples of how you have your portfolio structured and inflation deflation, and we'll talk a little bit more about you and your opportunities as a fund manager to our investor base, because I think that your strategy makes a lot of sense. And will make a tremendous amount of sense when things are shaken up a little bit. And I also believe.
Hold on. I'm sorry to interrupt. I'm going to say, I have to interject for a second. The strategy actually has made some the model portfolio has done very well in the past 2 years, because the key is not to just sit in cash or buy gold and short stocks. The model will tell you also when to patiently and in a hedge strategy make money as safely as possible while we wait for the calamity to start.
Right. That's why I mentioned it that way, because I know you're still making money right now. We'll get into those numbers in a second. But what are your thoughts on gold? Are you overweight already, or are you waiting for some additional signals?
Well, I am waiting for some additional signals. I do own gold. I think, first of all, if you don't have at least, I would say the starting point would be around 8% of your portfolio in gold, just because of North Korea alone, just because we have an existential threat to societies as a whole, based on threats going back between Pyongyang and Washington, D.C. So you have to have gold for that purpose alone. I also believe that we're getting close to the end of the Fed's rate hike cycle. I think their Fed funds rate will probably terminate around 2 to 2.5% before the calamity starts. But more importantly, the long end of the yield curve, I believe, is going to become unglued in the next few weeks. I don't say even months or years. I say weeks, because October 26th is when the ECB President Mario Draghi meets, and he decides what to do, or at least more specifically, how to taper his 60 billion euro per month QE program. And if you look at the German Bund trading at 0.4%, there's just no way without QE, massive QE, that rate will go anywhere or stay anywhere near 0.4%. It'll go well north of 2% very quickly. So as that rate rises, you'll see periphery countries in Europe, their rates, especially Spain, with the troubles going on with Catalonia. So Spanish bond yields will rise, Italian bond yields, Portuguese bond yields, Greek yields will rise. That'll drag up yields up across the globe. And I think given the level of debt and the very fragile nature of the U.S. economy, it's never grown really anywhere more than 2% since 2010. So given the rise in interest rates on the short and long end, I think you get a chaos to break out very quickly in the bond market and in the economy. That's when central banks reverse their policy. And it'll probably be a 2018 event where if you don't own gold, gold is, I think, is going to go to an all-time record high by early 2019. That's above $2,000 an ounce. But I think it starts early in 2018. So if you don't have any gold now, you better get yourself a hold of some immediately.
Well, one of the statistics that I find very interesting, and you don't hear about it a lot, is that the last time that gold crossed the $1,400 an ounce barrier in U.S. dollars, it only took less than 9 months for it to hit the highs above 1,900. Wow. So in this case, I think it happened sooner than that. So that $1,400 level, if we were to see that, as I believe we will by the end of the year, 2018, definitely see at least a retest of those old highs and then hit your target in early 2019.
Eric, good point. You mean it doesn't take that much time? You mean it doesn't going to take 9 months to get from 1,400 to 2,000? And here's the even better point. Gold mining shares have suffered so greatly since 2012. They're the bargain of the century. So if gold is going to go from 1,260 or so where it is today back to above 1,900, back to above 1,900 to 2,000. U.S. ounce. Guess what? Gold mining shares will absolutely, I hate to use hyperbole, but they double, triple, quadruple. They've done so in the past, and perhaps they're set to do so again in the future.
Well, that's an area that we specialize in, and I can just say that I think people forget how powerful the rallies are in the gold miners when they decide to be in a strong bull market. And then also how, the one thing we do remember, which is the most recent memory, is how much wealth destruction can occur in a bear market. So, there's the gold miners can boogie. So why don't you go to the inflation, deflation, and investment spectrum slide and talk about some examples of what you hold or what you would hold.
So you have to analyze where are we in this inflation, deflation spectrum. So, you have to identify the direction of real interest rates. Where are they going? So you need real interest rates real quickly. You look at nominal rates minus inflation. So if nominal rates are rising and your inflation is staying stagnant, then you're going to get real interest rates that are going to be rising. And that's not the best time to buy gold. US dollar direction, nominal yield spread and break-even spread. Look at that nominal yield spread. That's the 210 spread, and the break-even spread, the inflation break-evens. And if you look at that model, the model components I had up here, and if you know how to discern where we are in those model components, you could probably, if you have years of experience, decades of experience like I do, figure out where we are on this inflation spectrum. And it takes a lot of time and energy to do this. Why I don't mind showing investors. It takes a lot of dedication. This is all I do day in, day out. So if I could say today, we're sort of towards the left side of this spectrum, where we're leaning towards deflation as central banks try to normalize interest rates. Well, you want to be putting short some long dollar plays and some dividend plays. We had dividend plays up into October 26th. These dividend plays will be the most salient part of the portfolio. After that, I expect a huge spike in interest rates after October 26th and the meeting with Mario Draghi and his tapering plan. And that means we're going to try to drift more towards the middle of the spectrum. So you just slide along the spectrum. Eventually, after the deflation hits, and we'll be shorting stocks, we'll be shorting oil, we'll be shorting small cap stocks, we'll be shorting high yield, we'll have a high cash reserve. After that recession, depression takes hold, we're going to quickly switch to rapid inflation, which is sharply falling real interest rates. That's when the helicopter money and negative nominal rates kicks in. So you have to be able to slide along the spectrum. And if you can do it accurately, you'll not only make money during almost all occasions, I can't guarantee this, but during all conditions, you'll be able to make money. And most importantly, protect and profit from the next stock market debacle, which I feel is a 2018 event.
So why don't you go back to the first slide, and we'll talk a little bit more about details of how people can get more information on your services. We're already over, but I want to take a couple of minutes to talk about that. And then also the way you and I met was in a particular stock that we both own that I wrote a report on, and I know that you've been following very closely, which is Gold Money, XAU on the Toronto Stock Exchange, company that's got a very interesting business model. We obviously have some frustrations with the management communication issues, but definitely a genius model. It's essentially a cryptocurrency, your own cryptocurrency backed by gold,
Right.
because it's a blockchain backed system. And I have 3 accounts with Gold Money, one for my business, one for my personal, and then now the Gold Money holding personally as well. And so I think it's a terrific way as a customer to store physical gold around the world and also to move money around digitally. There's also the ability to spend via MasterCard. Why do you like that stock so much, and what's your take?
Wow, gee, you said it all. Well, so the only rap I have against gold, and it's the same rap that's been applied to gold for thousands of years. It's the perfect form of money. So it's very rare. It's virtually indestructible, and it's beautiful. It is portable. It is tangible. It is divisible. But carrying around large quantities of gold is very cumbersome. So what you have in gold money, XAUMF in America and XAU on the Canadian Stock Exchange, these people have created a private blockchain which is backed by gold. So they've taken the perfect form of money and made that perfect form of money into the world's most perfect currency. You can move fractions of grams of worth of gold around the world virtually instantaneously. I mean, why does anybody need cryptocurrencies and Bitcoin, which is not indestructible and certainly by no means rare? There's 900 cryptocurrencies out there, and they're not AML compliant. They're not compliant with the Know Your Customer laws. Gold money is, so there's no real threat of having gold money closed down, as China's trying to do with cryptocurrencies. So not only do they store the gold for you, they could allow you to spend the gold using a credit card. They allow you to move the gold around the world virtually instantaneously, fractions of a gram, for free. You can move it. I could give you gold. You can send me gold for free between each other. They also have a jewelry component where Mrs. Picasso has created jewelry that's 24 karat gold jewelry that will utilize the Gold Money platform. So you could buy the jewelry very close to spot price and sell the jewelry very close to spot price. They are the world's only repository of cryptocurrencies that are KYC and AML compliant. You could borrow against your gold. You could, the company has so many angles and so many things they're going into. I think they're very close to landing some very big contracts with some major big box retailers. That's my hope. That's what I think they're aiming to do. So it is a cheap stock, and so I think its market cap in Canadian dollars is under 400 million. So you're getting on the ground floor, if you ask me. So it's a big opportunity. Let me talk a little bit about myself.
Well, one second. Well, before you get into the
go ahead.
Gold Money, I mean, it's a great story. If they would respond to my freaking emails, then I think it would be a little bit of a better story. I mean,
they're working on they know that their investor relations stinks. They know that their customer service stinks, but they're
responding
working on
to an email from a newsletter writer who covers the stock, which
there's no excuse for that.
There's not a lot of that out there yet. So in any event, I'm going to tell people that I'm going to encourage, and we'll put a link for people to get a Gold Money account, but they're moving to this holding platform, which is very cumbersome at the moment. So I'll give a little bit of elaboration. It would be nice if these guys got back to me on my specific questions, because it's a lot of work to get the account open, but I know they're working on that. So let's talk about your strategies and your ability to invest people's money for them. Tell us a little bit about first and foremost, what's the performance been like recently, and what's your minimum?
So the minimum is $100,000 US dollars. We have some leeway with that. If you send me 90, I'm not going to throw you out of the office. Our performance was up. Our model performance was up north of 16% in 2016. We're up about 5% so far in 2017. And we've done this in a carefully hedged strategy. So this is the key. This is the magic elixir here. So the way we hedge the portfolio, we have some shorts, we have some precious metals. So if North Korea was to launch a Scud, an ICBM in the direction of Guam, the portfolio is much more protected than it would be if you were 100% in FANG stocks. So the key is to make money as safely as possible while we wait for the collapse to occur, be able to identify it beforehand, protect and profit from the next, what I would think, third 50% plus collapse in the equity market since 2000. A little bit about myself. I'm licensed since 1992. I raised hundreds of millions of dollars with Claymore Guggenheim for UITs that I created in 2007, 2009. I was the chief economist for Delta Global and Euro Pacific Capital, Peter Schiff's outfit. I founded Pento Portfolio Strategies in 2012 precisely because there was nothing else out there that was geared towards hedging investors against that dynamic of inflation deflation, which I feel is absolutely the most salient dynamic out there right now. We are going to be, as a globe, either massively monetizing deficits in perpetuity, which is inflationary, or we are going to allow the gravitational forces of deflation to take hold. And they are a collapsing stock market, a collapsing real estate market, and a collapsing economy. It's sort of a binary approach. There are times, like we've been in the past few years, where you can kind of skirt in the middle, and that's the big dance, trying to make money while we wait, but then to switch between inflation and deflation during those times of those dynamics come to the fore. I also authored a book called The Coming Bond Market Collapse. I wrote that book at the end of 2012. I never imagined that interest rates would be artificially low to the point of being negative when I wrote the book, but that's where they are. So the coming bond market collapse is coming, and it's going to be episodic. It's going to be apocryphal. It is going to be something like we've never seen before. And also I host the Pentonomics program and the weekly podcast called the Midweek Reality Check. My office number here is 732-772-9500. I'm not so big that I can't get on the phone with you if I'm free. My email is mpento@pentoport.com, and the website is www.pentoport.com.
Wonderful. And so people are interested, you can go ahead and call or email Michael. How many copies of the books can you give out to my guys if they email you or call you?
If they're qualified, and as long as Wiley still is publishing the book, then I would say plenty.
Okay, wonderful. So there you have it. Michael was good enough to send books to some of our attendees at the Phenom Conference. I would encourage you guys and ladies to reach out to Michael. And it's not a place where you'd put all of your money, but I think as a portion from portfolio allocation, he's got a really unique and interesting and really defensive strategy that's a good spot to park some dough. So, Michael, thanks so much for your insight today.
Thanks so much for being on with me, Eric.
You bet. Have a good day. We'll publish this early next week.
Great.
Cheers.
Take care.